Good morning or good afternoon to everyone, depending on where you are joining us from. We still have a few people logging in, so we're going to give them a minute or two to get settled, and then we'll get underway. Well, thank you for attending our Stormy Outlook for U.S. Plastics Refiners Risk of Stranded Assets in the Gulf of Mexico webinar. What a name. Today's webinar is being presented by Planet Tracker. Planet Tracker is a nonprofit financial think tank aligning capital markets with planetary limits, launched in 2018 by the founders of Investor Watch and Carbon Tracker, Mark Campanelli and Nick Robbins. At Planet Tracker, we're building upon the growing recognition that the finance community is not yet fully able to accurately quantify environmental risks and environmental data into investment valuations and decision-making. This is partly due to a lack of transparency, effective disclosures, and awareness around around company and market dependencies and natural resources, otherwise known as natural capital. It is our belief that if we continue business as usual practices, the degradation, if not outright collapse, of many natural capital resources will happen within most finance professionals' lifetimes. Addressing these issues, Planet Tracker focuses on 3 programs: oceans, food and land use, and materials. Today's presentation sits within our materials program. Today, we're looking in detail at the plastics industry and how the U.S. plastics refiners sector is facing 3 material risks along its plastics production corridor: overcapacity, declining margins, and physical risks from climate change. Before I introduce our panelists today, first I'd like to cover some housekeeping tips. Today's webinar is being recorded. The recording will be made available to you afterwards. During the presentation or following the discussion, we invite you to submit questions or comments in the chat box on your screen. We will try and address as many of these as possible. If you need to reach me afterwards, please contact me via email. I'm always available to answer any of your questions, whatever they may be, and I can easily introduce you to our amazing panelists today. We're grateful to have over 125 institutions, investors, financial analysts, and stakeholders in the audience today. Today, we will present the key trends that impact the plastics production corridor along the U.S. Gulf Coast, Mexico, Gulf Coast of Louisiana and Texas. It's a very thin strip piece of land where 89% of U.S. production exists. I'll then ask our distinguished panel to give their views on some of the points raised. Today's panelists are all experts in their respective fields. Gretchen Goldman. Dr. Goldman is Research Director for the Center for Science and Democracy at the Union of Concerned Scientists. And Horace Chan is a Chartered Financial Analyst and Senior Analyst who covers the chemicals and energy industry for Bloomberg. Let's go to the webinar. This image is what refineries in the plastics production corridor look like. One refinery after another, connected, like one large machine in a symbiotic relationship. All the businesses buying and selling from each other. In summary, the U.S. plastics resin industry is in a pincer. The industry is caught between increasing physical and business risks. The science is clear. Physical risks from climate change are increasing. Chronic risks from sea level rise are accelerating, as measured by the US government. Acute risks from storms are growing as storms are becoming more dangerous, as we have seen in recent years. Finance is also clear. There's overcapacity in the US at the same time as US sales as exports, which are dependent on exporting to trading partners who they themselves are increasing their own plastic supply, pursuing their own plastic self-sufficiency. At the same time, US margins are forecast up to 2035 to decline. This results in a near-term risk. About $56 billion in potential stranded assets for new refineries under construction in the US, including $40 billion potential stranded assets in Texas and Louisiana in the plastics production corridor alone. Investors must consider how they want to allocate their capital given these clear scientific and financial warning signs. Investors need to invest in the sustainable plastic solutions of tomorrow instead of the disposable plastic economy of yesterday. So let's look at the numbers so you can tell me what you think. Much of the US plastics industry, from natural gas to monomers to polymers, is along the plastics production corridor, a very thin strip of land along the Gulf of Mexico in Texas and Louisiana. The US plastics industry bedrock is the plastics production corridor. 89% of US capacity exists there, and 12% of global capacity exists there. It's a manufacturing, it's a key manufacturing center in the world, or a key cluster for plastics production in the world. The US plastics production corridor dominates 4 categories of plastics, as you can see in the screen. 97% of US capacity of high density polyethylene, 94% of US capacity of low linear density polyethylene, 80% of US capacity polypropylene, and so forth. You can see for yourself. The US plastics production corridor, the 34 existing facilities are named here in the slide. On the top, you will see a list of companies and facilities. The black lines are the 58 storms that have hit the coast since 1990. This is all modeled using open source data from the US government. I'm only the messenger here, sharing this story with you today. In red is storm surge risk from storms and hurricanes when winds are at 96 miles per hour or greater. What is in red is how much land would be underwater from a direct hit from these storms. This is an acute physical risk. On the bottom, you see the same list of companies and facilities with the same 58 storms modeled, courtesy of open source data from the US government. Thank you. What you see modeled is forecast sea level rise under a 2-degree target for global warming. This is what you and I might call a chronic risk. Let this sink in. Even under a 2-degree target for global warming under the 2015 Paris Agreement, many, not all, but many of these facilities, and especially the areas around these facilities that these facilities depend on, the roads, the power lines, the energy infrastructure, the supply chains, who they buy from, the companies they sell to, the towns, the schools, will all be at immediate risk of being underwater, impacted by sea level rise, even if we achieve our Paris Agreement targets. This is modeled using US government data, freely available to all. What we are describing is not a forecast. It has happened before. We are the messengers to share this story with you today. Look with your own eyes. In 2017, Hurricane Harvey, a horrible storm, shut down 75% of US polypropylene capacity. It directly impacted at least 26 facilities in the plastics sector and shut down a total of 68 facilities or refineries in the chemical sector overall. All of these facilities were in the plastics production corridor. In 2020, 5 storms hit the Louisiana Texas coast directly. They directly impacted US capacity from 7 to 28% of resins. Sorry, I went one slide too fast, as you can see here. I need to note that some of this shutdown was also due to scheduled maintenance that occurs in a 3 to 5 year time frame. But the shutdowns exceeded all industry capacity, industry expectations at the time. These are the 14 companies with facilities in the plastics production corridor. These are the companies with existing facilities in your investment portfolio. These are the companies you are invested in whether in fixed income, through bonds and loans, or in your equity portfolio. It makes us ask the questions I'm sure you're asking yourself right now also. How are investors and portfolio managers managing the risks from sea level rise and increasing storms that exist even if we achieve our 2-degree target for global warming under the 2015 Paris Agreement? Even if we achieve the agreement's goals, the physical area where these plants exist, their roads, their supply chains, the schools, the towns will face still increasing risk from storm, surge, and sea level rise. Moving on. On top of these physical risks from climate change, the plastic production corridor and its companies' growth forecasts lag or are less than global forecasts from now to 2035. You can see that on the screen. For all 4 of these resins produced in the plastics production corridor, growth forecasts are less than the global average over the next 15 years. This data is from Bloomberg, courtesy of Nexent. Again, we are the messenger. In fact, US growth forecasts are heavily dependent on increasing US exports. This means exporting into markets that they themselves are increasing their own capacity. It means exporting into markets already flooded with plastics produced by their own domestic markets, where many of these countries, as at the executive level of the country, are working to achieve plastic self-sufficiency. Industry leaders who cover and create data in this sector, Bloomberg, ICIS, Argus, all report the same trends. Large-scale capacity additions outside the US and markets the US exports to currently are all adding to their own plastics capacity. That's $163 billion of capacities planned to be added to the market the next 5 to 10 years. The economies the US used to export to are now producing their own plastics and becoming self-sufficient. So it's going to be more difficult for us in the United States to export to them. They will not need our products. This is why in the US market, while sales are forecast to increase to 2035, the top lines here in solid, as you can see, the bottom dashed lines are what matter. It shows that margins, which are also called profitability, are forecast to decline. Who wants to sell more and more every day and make less and less profit every day? This is a losing proposition and goes against all business logic. Why spend more and more effort to make less and less money? I went to business school. That wasn't one of the courses I took. Excuse the cheeky joke. So the question remains, Why are investors investing in expansion in the plastics production corridor? There are $40 billion in projects forecast to start producing more single-use plastics, more throwaway plastics in the plastics production corridor by 2025 in just the next 4 years. These are the companies who are engaged in that build out. Financial analysts and investors ask me and us at Planet Tracker these questions all the time. Are they dependent on exporting to markets that are already saturated? Why would a company depend on exporting to a market that's already saturated? Are these companies expecting to sell their plastics to countries that are becoming self-sufficient, who do not need our content, our plastics? Why are these companies building out refineries that build single-use plastics, the products of the past that served a good purpose, but the products of the past, whose margins are forecast to decline, to become less and less profitable, requiring more and more sales effort as data has shown us? Why are companies building out more refineries to do that, as opposed to repurposing their existing refineries to build sustainable plastics solutions of tomorrow that in many cases are much more profitable? Companies are facing physical risks, in summary, pardon me, companies are facing physical risks from climate change. It is unrelenting. These risks are increasing even if we achieve the targets of the Paris Agreement. If we achieve the targets of the Paris Agreement, the sea level will continue to rise. It will rise at a lower rate, but it will still rise. Storm surge will continue. Sea level rise at every United States government measuring station along the Gulf of Mexico is rising at a much greater rate than the global average. There are measuring stations along the Gulf of Mexico that no longer can measure sea level rise because, I'm not making a joke here, they sunk. They no longer exist. That's not a good sign when you have your $10 billion facility next to that measuring station. Storms are becoming more and more fierce and more damaging, as we've highlighted. Economics are becoming more and more challenging. Growth forecasts at 2035 are dependent on increasing the use of single-use plastics, a product that is already in many places being replaced by business innovation and exciting tools of tomorrow, of sustainable plastics, a fabulously interesting business line. So why throw good money at bad projects in the plastics production corridor? Why not instead use investor capital to finance the transition to a sustainable plastics industry, to a more profitable industry? The message we hear, we at Planet Tracker hear from industry is investors and companies must understand economics of declining margins and global oversupply and incorporate that into their 2030 forecast up to 2035, pardon me. We hear that companies need to publicly disclose both their supply and demand forecasts and analyses of climate-related risks. We hear that investors may benefit from actively seeking to delay and cancel projects and instead focus on repurposing existing facilities to higher margin growth sectors that solve the plastics crisis. This is what I hear on a daily basis. Investors in companies, in summary, may want to seek to delay or cancel projects as a hedge given stranded asset risk. With that, I'm going to thank you both, everybody, very much for listening. And now we'll go to our Q&A with our distinguished guests. So our first question is, what is a stranded asset? And I think I'll take that out quickly and briefly describe what that is. A stranded asset is an asset whose economic life is not, whose use is less than its economic life. If I buy a car for $10,000 and I expect to use it for 5 years, but in 6 months it breaks down, and I can no longer use it, it becomes a stranded asset. That's what industry is facing now. They have deployed an enormous amount of capital, enormous amount of dollars, and built all this infrastructure, but they're not going to be able to achieve the economic rates of return they forecast years before because of physical risk from climate change, whether sea level rise or from a storm surge and increasing storms. And they're not going to be able to achieve the expected economic rate of return because of changing global economics. So Gretchen, I'd like to ask you a question if you don't mind. You have worked in this industry on and off for many years. Your team at the Union of Concerned Scientists wrote a fabulous first report on this subject in 2015, when you looked at refineries and described ways that the institutions such as Morgan Stanley now, which is at the time Calvert Investments, but Morgan Stanley's company that that they recently bought, could engage with investors around climate risk. Do you have any thoughts on how stakeholders in the scientific community should engage with investors and support investors in making better capital decisions?
Thanks, Gabriel. That's a really great question, because there's lots of ways now that the scientific community can directly engage with investors, with companies. On the science side, we've seen huge advancements in recent years around climate impacts and what we can attribute to climate change. And that information is tremendously valuable to investors. And there should be a lot more integration there in thinking about how do we take what we know about what the impacts of climate change will be and apply that to financial decisions. And with respect to this issue, that's especially true around sea level rise and storm surge. At this point, sea level rise is very well known. We know what's going to happen out to 2100 in terms of how high the seas will get. You know, that's very good data that we have high confidence in. And so that will give a lot of concrete knowledge to companies, especially those in low-lying areas like this plastics corridor, and that can be directly integrated into investment decisions, into company decisions about, you know, where to invest and where might be a greater risk of stranded assets. So I think that's one thing that we can do. Ways you could do that, I think one is ensuring that science and scientists are at the decision-making table. So anytime there's opportunities to directly involve those familiar with the scientists, to those familiar with the science rather, to be at the decision-making table, that can allow for more integration. I think we do need a lot more communication between the scientific community and the business community, and thinking about how to make sure that the data and the knowledge on the climate science side is accessible to and in a usable format for those making investment decisions as well.
Gretchen, that really makes me think of a possible solution. For example, if I'm a large corporate plastics producer today listening to this webinar, it's going to be a bit tough for them to want to listen to all the details. But there's also some solutions here. Do you think it'd be appropriate for some of the plastics refining industry to consider having US scientists on a scientific council that would guide them, for example, to support them with transparency and data, help create efficiencies around investment decision-making from a scientific perspective? Would that be
I think
option?
That's a great idea. I think it would be great to have scientists that can be involved, and there's lots of opportunities for that. There's lots of scientists and other technical experts that think about these kinds of things that would be happy to advise companies in how to think about this. And I think there's just a lot of potential there as long as we all can talk to each other.
Yeah, exactly. We only have one planet, so we are going to have to talk to each other. Yeah. So Horace, you're on the economic and financial analyst side of the business. Do you see stranded assets or global oversupply? And knowing that you have a global view, what do you see given this information? Yeah.
Thanks, Gabriel, for the excellent presentation. From the financial standpoint, there's actually some questions have been raised in the Q&A on the financial side of the equation. In fact, in our understanding and analysis, we are projecting around on the ethylene side of the chemicals sector or plastic sector, there are a huge capacity addition, not only from the US, but also increasingly from China and the Middle East as well. And if we combine all these capacity to be added in the next 2 to 3 years, it's around 30 to 40 million tons of capacity being added totally from the world. And if we put into context, that is around 5 to 6% supply growth per year in the next 3 years. But on the demand side of the equation, it's the demand growth would normally only be 2 to 3%. So just from a economic standpoint, we'll see a supply glut in the next 2 to 3 years if the planned assets were to be put on stream and running smoothly. So from an economic standpoint, some margin for the plastics industry will be squeezed. And but if we take a step back and think which company will have the highest risk economically, then it will have to be the European plastic sector and some of the Asian assets, which are relatively old and inefficient and not able to compete with the world. Those assets sitting on the Gulf Coast are based on ethane gas, which are highly economically competitive.
Yeah, no, that's absolutely true. The ethylene spread between North American assets on a cracker level versus European assets, I think right now is 1.8 or so. So in other words, the feedstock at the European level is 1.8 times more expensive overall than versus the US. Yeah. Do you see a greater leverage in the industry? How are these companies financing their expansion? You know, with Exxon building out a $10 billion facility along the coast, and then the larger Chinese expansion that's occurring in mainland China, they're about $20 billion a piece. How is expansion happening? Is it equity or they're fixed income? Horace?
From the financial standpoint, these companies are still relatively financially sound. From a cash flow perspective, even though the industry is likely going to see a squeeze in margin, they are still able to fund their capex because they are still having cash flow from the currently running assets. And especially from the US standpoint, they are able to fund because they are the most competitive assets. If not, they are a very competitive asset, and they can able to generate enough cash flow to fund their expansions. In Asia, however, the story is different. We have seen a number of new entrants into the chemicals field, say that they are polyester textile producers, and they're integrating upstream into producing plastic products. And these private companies are funding their expansion through government endorsed programs and through a lot of syndicated loans. And through that, their expansion is actually driving up their leverage by significantly. Yeah.
So, no, thinking on that. So while the companies, you know, given the premise that the companies along the Gulf Coast, their margin is declining, yet they're still cash flow positive versus other companies. I'm saying this in shorthand, if you don't mind.
That's right.
But wouldn't these companies along the Gulf Coast, because they're cash flow positive, want to consider repurposing their facilities for the sustainable plastic solutions of the future, which in many cases are much more profitable? If you look at recycled PET, which is not, PET is not developed, is not produced along the corridor, putting that aside, okay? But recycled PET in Europe versus virgin PET in Europe, recycled PET prices, according to ICIS, are at least 2 times the price of virgin PET because of the global demand undersupply of recycled PET, the global undersupply or lack of supply of plastic solution product. So wouldn't I, as an investor, want to push companies to invest into use some of that cash flow to repurpose facilities? Horace, what do you think?
I think it's it's the company. The question is really complicated and can be answered in different angles.
Yes,
I
of
think
course, yes.
definitely on the one hand, we'll definitely see companies start to rethink about the future, especially under COVID-19. The entire plastic industry is also undergo great changes, and companies really rethinking about their expansions. In the US, we have at least two crackers rethinking their investment in a cracking facility. They are PTT Group and the expansion from Formosa. And these two companies have delayed their expansion program in the US. But that said, from an economic standpoint, I think still when companies doing their planning, they will still look at normal project metrics, for example, the IRR, whether they still make sense economically to make an investment like that. This is on the one hand. And on the other hand, I would like to just bring up a point that a lot of companies worldwide, including say Dow, Londell, they are investing a lot in the sustainable solutions, including biodegradable plastics, recycled materials, and these would likely to be the sustainable or the future of plastics industry. But the development of those are still in an infant stage, and we'll definitely see a time where the recycled materials or replaceable materials cost will be equally competitive than virgin materials.
Yeah, well, that's the exciting part of the industry. I mean, I wish I had invested in Microsoft in the early 1980s for us, you know. It's when the sector is in its infancy and it's growing, we get those nice investor curves. And here around on efficient deployment of natural resources and capital, I mean, pushing us back to the scientific data, Gretchen, how do investors, like the largest investors on the earth, let's say a Vanguard or Fidelity, or regional investors, or companies themselves in the plastics production corridor, how do they reach out and talk to scientists in ways that help them? What are the type of things they need to do on, let's say, a corporate reporting level? Should they report their scope 3 emissions? Should they report their physical barriers they create around production facilities, such as berms and seawalls and other sort of risk management, physical risk management tools they have in place? But do you have any thoughts on how these companies should start to reach out to institutions in your community?
Yeah, absolutely. I think there's a lot of space for improvement around disclosure from companies around climate-related risks, and a lot of the topics we're talking about in the U.S. Companies are asked to disclose material risks by the government. Public companies are. And that is inclusive of climate-related risks. The Securities and Exchange Commission has specified that needs to be included. However, we don't see companies treat that the same, and many companies don't disclose much at all about their climate-related risks, but they should, and we should get to investors should get to see that, the public should get to see that, and the regulators should get to see what companies are doing and not doing around these related risks. It affects investments, of course, and it also potentially really affects the communities around these facilities, which are also very concerned about risks from storms and sea level rise, and what that might do to pollution in the immediate future and around them all the time. So we do need to see better disclosure from companies. And I think if we do, that would allow for more scrutiny around what they're doing from the scientific community. It would allow other experts to see how companies are managing these risks or not. So I think the kinds of things that would be useful to see more of from these companies is more specificity and details about what they see those risks are, both on the physical risk side of the infrastructure that's low-lying, as well as any regulatory risks and liabilities, legal risks around this, because we're seeing sort of a new era where there is a lot more activity around litigation with these companies, around potential regulation that might come up in different countries. So we do need to see a lot more from companies about what they're doing. And I think disclosing what they are doing about those risks would be great to see. Right now, there's often we see sort of vague statements in these disclosure forms around the risks are being managed, where we have it under control, but there's not a lot of specificity of whether that means, is there, did you put up a physical barrier to protect a facility that's below sea level? Did you reinforce the infrastructure there? Have you removed more dangerous, more flammable chemical stockpiles away from risky areas? These are all things that are of vital importance to investors, to the communities around, because they do potentially present tremendous risks. So I think there's a lot of room for there. Absolutely, companies should be disclosing their Scope 3 emissions. These are crucial to accounting around what their impact is on climate emissions overall. And without that, we don't have a lot of information that they can get feedback on and improve.
Yeah, I keep thinking, well, first of all, I think I forgot to press end show. So I don't know if the audience is able to see our distinguished speakers talk. And that's my Zoom fail. Very sorry about that. So now back to the presentation today. Do we see a scientific risk premium when companies just, because data, if we make the premise that data is our friend, companies that disclose more, are they seeing a premium in industry? Have you seen anything like that, Horace, whether in the polymers sector or more broadly in chemicals or in the food and ag sector or elsewhere? Have you seen a premium for companies that just do a better disclosure?
Thanks, Gabriel. I think the premium that we've seen is unlikely to be that easily quantifiable from our side, because Bloomberg has just started the work to quantify the ESG data disclosed by the company, but actually the data disclosed are less comparable against each other. And on the one hand, especially comparing across global peers, let's say a company in the US comparing the company in Japan, that will be clearly a difficult task for comparison. But just from, however, if we take a closer look into how companies perform in regarding to the ESG score, we have seen some correlation between high ESG score and strong equity stock performance in the longer run. But the correlation isn't that strong though, but we're starting to see that happening for those companies in the developed market, say Japan.
It's very interesting to me, because I would think that there could be a sustainability premium by disclosing data. If I'm one of these companies that wants to build out what could become a stranded asset along the Texas-Louisiana coast, it would be my interest to disclose my physical climate risk forecasts, so that in working with scientists, so they can make that forecast replicable, public, consistent across industry, across sectors, because the stronger their data that they present, the stronger the financial case is for the investor. Data is your friend. And so with that, we need to start wrapping up the presentation today. I'd be curious if either of you would like to have a couple last thoughts and around stranded asset risk and physical risks and supply and demand forecasts along the plastics production corridor. And with Horace, I'll put you on the spot to go first, please. Thank you.
Thanks. Just my final thought is that a lot of companies, global chemical companies, are investing into the future. And in Asia, we have, say, companies committing into net zero target, just like the developed market. So we're starting to see an improvement in trends for chemical companies to target sustainable development. And we are also, in fact, we're seeing plastic companies trying to develop biodegradable plastics, although the development is still in early stage. Recycled or recycled or biodegradable materials are currently still at 2 times or even more the price of virgin materials. So if we want to have large scale of substitution happen, it would still take some time. But I think the industry is heading to the sustainable direction ahead.
Yeah, it'd be great to get more capital into those industries moving in the right direction, because those margins will only improve as we as consumers start to pay a better price, the right price for the pollution we create. And Gretchen, last word for you, please.
Yeah, I'd say companies should start to see the writing on the wall. This is a changing industry. This is a place where we're expected to see a lot of change in the coming years. In the US, with a new president coming in, we can expect potential regulatory changes as well. There's a lot of changing around public opinion on plastics, on climate action, and around companies' roles. We're seeing communities that are at the fence line of plastics production facilities take a bigger role in demanding disclosure and communication and mitigation of a lot of these risks. So companies should try to get ahead of the curve on this, start being proactive, start thinking about how to mitigate a lot of these risks, given there may be quickly changes in demand, changes in the profitability of these, as Gabriel said. So there's a lot that they can do and they should do, and they'll need to do if they want to stay competitive in this new era and be on the right side of history.
Absolutely, could not agree more, Gretchen. Communities and scientists are your friends, companies out there and investors out there. They're your first eyes that can see a problem before you do, and they can help you. So with that, thank you all very much, especially Gretchen and Horace. Too bad we're not in person, but a round of applause for our distinguished guests today. Thank you both. Thank you, the Union of Concerned Scientists and Bloomberg, for participating in this. And we're very grateful to all of you that attended. There are about 30 some questions, if not more, that have arrived, and we will create a log to answer all of them, and you'll be in touch with both speakers. Thank you all very, very much. Have a nice day.
Thank you.
Thank you.